Hello everybody. For this video, thought it would be best to give everybody a visual of what we potentially have going on in the S&P 500. The last few months we've had a lot of bouncing around between 1100 and 1300 really. But the last few weeks we've really set up a new channel between 1160 and 1260 with a brief move up to 1280 and 1290 in late October. Now what we want to point out are two potential technical formations that are going on right now. One of them which would be bullish, the other one which would be bearish. What are the two, you ask? A potential inverse head and shoulders pattern or a potential double top pattern. We'll start with the bullish one first, an inverse head and shoulders pattern. So what this is, you can see on the visual, it literally looks like a head and shoulders flipped upside down. You've got the left shoulder, the head, and then the right shoulder. So the price falls to a trough and then rises. So here we have our fall right here and then the rise, okay? Then the price falls below the former trough and then rises again. So okay, we rose and then look what happens. We then fall below this former trough, this low here, all the way down to 1160 from about 1220 was that low. And then we rise again. Now the third part, the price falls again, but not as far as the second trough. So here we go. We rose, and now here we've fallen again, but not as far as the second trough. So you can see this would be our left shoulder, this would be the head, and over here what is potentially going on right now would be the right shoulder. Now, in order for this to stay a valid right shoulder and keep the formation intact, we need the initial low of the left shoulder to hold, which is 1215. Today's low on the S&P was 1219. So there's not much leeway here to keep this pattern intact, but it is still very much intact. And one of the things we like about this potentially is that, as far as we know, we haven't really heard the media pick up on this potential technical pattern. You're not hearing it being talked about on CNBC or Bloomberg or written about on Market Watch or Seeking Alpha. Maybe we're wrong, but we haven't seen it anywhere. So this is good because it's a potentially very bullish technical event that is going unnoticed, which makes the most powerful technical rallies are the ones that catch people by surprise. So what needs to happen for this to be confirmed? The S&P 500 cannot go below 1215. Furthermore, we then need to rise back up, just like you see in this example right here. You see the neckline is the two highs. So here's our neckline, one high, two highs. So we would then need to get a rise and break out above about the 1268 to 1270 level on strong volume, and that would confirm the inverse head and shoulders pattern and set up a target near 1300 to 1325. That is the bullish scenario that is potentially in place. So remember, we need to hold 1215 for that to play out, and we need to start trending back up to form the rest of the right shoulder, just like we had here with the left shoulder. Now, that's the bullish case. What about the bearish case? Well, just like we have a neckline here potentially, that neckline is also a double top. If you look at the chart here of the last 30 days, on 11/11, the S&P 500 traded to a high of 1266.98, and on December 7th, the S&P traded to a high of 1267.06. So pretty much picture perfect double top, give or take a fraction of a point, which we're not going to be stubborn about. That is a double top that is in place right now. So what needs to happen for this to be confirmed, you're asking? Well, we need to drop below this recent low over here of 1215. And what that would do is that would confirm the double top formation, and it would likely lead to a test of this low from November 25th at 1158. Now, if that low failed to hold, it could get really ugly because this is a key low. You see, we had the 1074 low back on October 4th, and now this 1158 is really the higher low that's been in place. So if you were to break that, there would be nothing stopping the S&P 500 from trading back down to 1075. So it's pretty clear cut right now. We're in a tight range. The bulls need the S&P to stay above 1215. The bears need the S&P to get below 1215. And so until we break out of that range, break below that level, then the bullish formation will be kept intact. And until we break above that 1270 level, the bearish formation will still be kept intact. So we're kind of in a 4% channel here between 1215 and 1270. And you can guess and you can hope which way the market is going to go. But until we get a breakdown below 1215 or a breakout above 1270, we're in this channel, just like we were in this channel here for so long, from August to October. And then here we had our channel from late October to November. And now here it looks like we're maybe putting in another channel this last month of December. So 1215 to 1270, that's the range we're in. Get short aggressively on a breakdown below 1215. Get long aggressively on a breakout above 1270. And anything in between, just play the range. So there you have it.